This podcast is supported by Invesco. Why invest in ETFs? Because there's a solution for whatever your portfolio needs. Whether you're exploring ways to manage volatility, seeking income and diversification opportunities, or looking for tax management strategies, Invesco has over 200 ETFs to help you meet your financial goals. Discover the possibilities at Invesco.com/ETF solutions. Before investing, consider the fund's investment objectives, risk, charges, and expenses. Visit Invesco.com for a prospectus with this information. Read it carefully before investing. Risks involved with investing in ETFs, including possible loss of money. ETFs are subject to risks similar to those of stocks. Invesco Distributors, Inc.
Recently, many things are happening in the markets. Rising bond yields, the sound of inflation risk, stock market fluctuations, Bitcoin taking center stage in the media cycle. So many things to talk about. So how should we view all these things while managing our investment portfolios? Will the rise of all things digital change the way we invest? How should we embrace all these dynamism out there? We will be covering a lot today while we, just took a break last week. So welcome home. Welcome to another Chill with TFC session. In this series, we hope to bring in interesting, relevant people to help us learn better from various perspectives. Life is not always about learning from people that you already agree with. Perspectives shake around the thinkers. In our pursuit of the life we love or managing our finances well, our guest for today is a seasoned investor that's staying firm that passive investing with low fees is the way forward for many. He has interesting takes on the many things that's going on in the market, but that does not drastically change his investment strategy, believing in winning the war rather than focusing on the many small battles. While there are many ways to invest today, he is staying old school, buying assets that generate cash flow. To him, there is a science and it's logical. We have with us today founder of one of the leading Robo-advisors in the B2B space today. Welcome, Tai Zhi from AutoWealth. You guys are doing the whole very macro-driven kind of thematic way of investing. Could you just kind of share with us a little bit more, like, what is your strategy to do that?
Yeah, so we want to make sure that our investment strategy is simple and easy to understand, because at the end of the day, these are your hard-earned savings, right? You want to make sure you know what's going on, then that gives you more comfort, more confidence during your investment journey. So that's what we are trying to do. And in simple English, what is our investment strategy?
English,
right?
Yes.
Today, we try to track the global stock index. In this case, the MSCI All Country World Index. So whatever the index holds, you actually hold the same. So if you throw a stone and you hit a listed company, there's an 85% chance that you actually own a piece of it.
So in that sense, why go for that broadly diversified strategy? Because recently there's been a little bit of discussion online, about how do you even beat the market in that sense?
Yeah, so for us, we focus a lot on asset allocation to derive returns. We focus less on market timing, and we do not do anything about stock selection. Yeah, so asset allocation means basically if you want to set aside a certain percentage of your capital investing into US stocks, how much is that percentage? So that allocation percentage is what we mean by asset allocation. Yeah, so what we are trying to do here is to focus on the big picture. If certain regions do well, your portfolio does well. So there's no need for you, to agonize over, sometimes why DBS is going up, but why not UOB, which is the one you're holding? Yeah, and why, in certain timing, Tesla keeps going up, but the moment you start investing, it starts crashing down on you. Yeah, so we want to avoid that kind of agony. So we focus on the big picture by just diversifying across the whole world.
Okay, so the very big, slow game in that sense.
Well, if you come to think of it from our investment track record, we have been delivering a good 8-9% for people belonging to the higher risk group. So I don't really think that's very slow. If you compare to your fixed deposits, your bank savings, which you will never get there.
Yeah, for sure. And in that sense, about the way you guys are doing it, it's very macro-driven, very broad-based. So then, are you very concerned about the endless money supply that's coming into the picture? Countries are just printing and spending. Of course, it's a lot more complex than what people think as. like all the $1 trillion stimulus is not as simplistic as really just throwing money out there. But I want to hear your thoughts about like, are you concerned about, that kind of stimulus numbers?
The central banks are doing a lot of monetary easing, meaning printing money, increasing money supply. And what they are trying to achieve here is to prop up inflation and to prop up economic growth. So the intent is well thought of. And we don't think inflation is necessarily a bad thing. If we have, for example, close to but below 2% inflation, that's the best in economics terms.
Why is that the best?
Because you want to make sure that the corporates that produces that goods and services, they can increase their prices year on year, but increase it at a moderate pace. Because the moment they can increase their prices, they make more profits, they can employ more people, and then more people earn more income, and then you continue to spend again. So that's a very positive reinforcing economic cycle. Yeah. But whereas if you have deflation, which means year on year, the goods gets cheaper and cheaper, what people are going to do is to delay their purchases. This is what's happening in Japan, right? For example, if you want to buy Japanese electronics, if you choose to delay it by 1 year, you get it cheaper. So many people keep delaying their purchases and the economy can never get back on track.
Can you help us elaborate a little bit more about what's happened in Japan? Right, because over the past 30 years, there's a whole deflation cycle in Japan, right? Yeah, so I want to kind of hear your viewpoint on this,
Yeah, so this has been the case for a couple of decades, and it has kind of etched into people's mindset, and mindset are very difficult to change. So everybody knows that Japan is in a deflation cycle, and everybody, refuse to spend that much. The Japanese likes to save a lot of money. So it is actually a professional business, to just take in old goods, take in your karanguni stuff that people throw away. And you often find that if you cut up the mattresses, if you cut up the pillows, sometimes the Japanese old people, they bury their cash inside the pillows. And they forget about it, and they pass on. So it's actually a very lucrative business, taking in all this trash, and for all you know, you find gold within the trash. Yeah, so that's really the mindset of Japanese people today.
So are you trying to tell us that the Japanese economy is shrinking?
Well, in a way, the rest of the world is moving far ahead, and we are growing each year. And Japan, on the other hand, is not growing as fast as they want and as fast as their potential can be because of the situation on the ground.
And why do you think they have potential to grow?
Well, if you look at many of our technologies today, Japan is still one of the leading technology players. For example, if you like gaming, Sony PlayStation is developed by Japan.
Woohoo, Nintendo.
Yeah, Nintendo as well. Yeah. So there are many different areas where the Japanese are very strong at. Yeah. So I don't think that's going to change. But however, if you look at the overall economy, there are many other sectors that they are dropping back from the global competition.
And in that sense, within the Asia space, right? If Japan is not growing as fast, and then the rival, okay, maybe not rival, but the other guy, the neighbor, right? China is growing
yes.
neighbor. China is growing like crazy, like on fire, or at least that's what people see on the surface, right? GDP is growing and growing, and it's like the 2021 hot take kind of thing, right? Will China become the next big thing? Or actually, it's been around for a long time, like this question of will China become the next big thing? And so what is your take on that? Because it does not really reflect on. At least from my homework with your portfolios, it doesn't really reflect that kind of like, oh, we're very aggressive on China. You guys are just, it doesn't feel that way. So I want to hear your perspective.
Yes, we really love China, and we really love the Chinese economy and the companies.
Woo, China!
Yeah, but however, as an investment asset class, we are not allocating a huge chunk of our capital towards China. There are multiple reasons why this is so. Today, if you look at the Chinese stock exchange, there's the A shares and the B shares, which most people, most foreigners, wouldn't be able to invest in. There's only H shares that's listed on the Hong Kong Stock Exchange, whereby it's freely tradable. So it is a very restricted market in China. And they restrict this for good reason. The Chinese government doesn't want foreigners to take control of their key industries at a too premature stage. They want to make sure they grow to a giant status, before they gradually open up their economy. So it is very controlled. And the same way how, the Chinese government likes to control every single thing in their economy, right? When Ant Financial grows too big, they have to rein you back. When Tencent grows too big, again, they got to pull you back a little bit.
So how does that then discount into your investment strategy?
So the global index provider, the most well-established one is MSCI. So MSCI, because of these restrictions on the trading of A shares and B shares, their allocation to China within the MSCI All Country World Index is pretty small. So it reflects the kind of restriction that China have. So it's a reflection of reality. So while they are slowly opening up, so you can see that the Chinese weightage is slowly increasing, now I think close to 4%. But it's still not a reflection of the second largest economy in the world. But we are gradually getting there as the Chinese government continues to open up. So from our investment perspective, we also take pace with what is developing in China, this gradual opening up.
Which means that you guys are not trying to jump the gun. You're not trying to be overweight, own more of China.
Yes, because even if we try to do so, we can only do so through the H shares. And the H shares doesn't represent the entire economy in China. It's not a realistic representation. So if you want, your Chinese internet companies, not everybody has a H shares traded.
And if we bring that back into, the future of the world, right, where economy is very digital and things go everything is online, right? So then if we're talking about China opening up in this process, and there's this whole discussion about the digital yuan, what is your take on this? How will this change, the global financial space?
So China is growing in influence. So that's something which we are very sure of. But from an investment perspective, we do not only focus on regions. We also focus a lot about the industries that are emerging. For example, today you have fintech, you have e-commerce, and the likes of that. And these industries could be expressed in our investment views. Recently we have a new offering called AutoWealth Plus, where, for example, we have one portfolio called the Future of Digital Economy, where we focus a lot of the allocation on fintech, internet companies, e-commerce, and the emerging markets that does all these few industries. We also have, for example, the Future 2050 portfolio that focus on technology, which reinvents itself from time to time. In the past, it used to be Dell, it used to be HP. These are the tech giants. Today nobody remembers about those companies, right?
Who still use Dell? Who still use HP?
Yes. Today it's like Apple, and we are no longer that much focused about hardware. We are looking a lot about software as a service. So you have many companies like Salesforce is coming up, and displacing, the old incumbents. So these are some of those industries that we like, as well as healthcare, because aging population is a global macro trend across both the developed economy as well as the emerging markets. So whether be it Japan, which we all know is a graying population, or Singapore, which is already happening, we also see that China is also facing the same issue. So healthcare is going to benefit a lot from this global macro trend. So another perspective I want to share is to focus on the emerging industries, because if you get those right, you get a lot of returns.
What are some of these emerging industries?
So I've shared fintech, I've shared internet companies, e-commerce. I also like the future of computing.
Like cloud?
Yes, cloud as a service. Yeah. As well as robotics, the future of industries.
But a lot of these theme funds, right? A lot of these thematic ideas, right? They tend to fall into this hype cycle, where by the time the ETF is out, right, the underlying equity has already been bidded up like crazy, right? It takes about 6 months for a theme for an ETF to get out of the gate, right? After inception, after ideation, okay, we're gonna do this. 6 months down, then they will come out the gate. By then, it's already been bidded up. A lot of the underlying asset class. Are you concerned about that kind of reality?
Yes. So you are absolutely right. If we look at fintech as an industry,
Woohoo!
fintech has really started, way long back. 10 years ago, we have the first robo-advisor in the US. And if you look at payments, e-payments, that took place in China way, way long back. Yeah. But however, if you look at the investment instruments where we can invest in these emerging industries, the ETFs like your ARK Invest that are developed by ARK Invest, they only came out in the last few years.
Yeah.
And they only gather pace in the last 1 year or so.
Yeah.
Yeah. So it's a little bit lagging in nature. And you will see a lot of overhype from time to time. So to rectify or to resolve such hypes, right, we need to focus on the long run. We need to make sure that whichever industries that we have identified, there are industries that can continue growing at a very fast pace for at least 5-10 years kind of time frame. So that as long as they continue growing, the hype will eventually become reality, and then we will continue growing healthily again.
Okay, help us understand a little bit like what is considered a fast pace. 20%, 30%, right? What is the overall market growth, that is considered fast?
Yes, so I will share with you this company which today I think a lot of people will be well aware of. Is this company called Tencent.
Okay.
So Tencent runs your WeChat, and
QQ.
Yes, QQ, and their core business is actually in gaming. Yeah. So long time back, I started investing in Tencent. The ticker of Tencent is listed on Hong Kong Stock Exchange. The ticker is 700 HK. And at the first time when I first invested in Tencent, they were trading at like $100 over Hong Kong dollars. Okay. And I started making like 30% profits year on year. In terms of their earnings, it is also very fast, like growing at a pace of 30% year on year and persistently for a number of years. So at many points in time, I question myself, can these be sustainable? They have been growing, they have doubled. Can they continue doubling? Yeah. So, as a personal investor, I've exited those positions, quite early, almost, I think, just below 200 Hong Kong dollars. And look at where Tencent is today. I've missed out the subsequent growth. So it's unimaginable how these industries can continue to grow, as they gather pace, because you must remember that China as a market is extremely, extremely huge. You are talking about, more than 1 billion people and more than 1 billion people consuming your goods and services. So when they started off in a particular region or province in China and they continue to grow to other provinces, it's going to take time. So this growth is going to be multi-year, sometimes even multi-decades.
Nice. And then in that sense of the pursuit of growth, right? Can you just kind of help us paint a picture of like, how do you see these companies keep growing and keep innovating, right? Because a lot of people are saying like, oh, we're going to grow. But honestly, 30% growth, right, is quite crazy. Like, that's not happen all the time, okay? 5 years, 10 years is already quite nuts. But how do these companies or how do these sectors keep on, keeping up with something like that?
Yeah, so it's very difficult to identify, a company that can persistently grow like Tencent. There's only that few names, right?
Yeah.
That can do that. And it's today that we have perfect hindsight that
Yes.
we see Tencent and we see Alibaba.
Yes, so everybody keeps saying Amazon, Microsoft. I was like, dude, that already happened, right? Just
Yes,
tell me how to pick the
yes.
next guy.
Yes.
Yeah.
So our strategy has always been, don't do your stock picking. There's no point trying to fight all these small battles. All you need to do is to focus on the big picture and win the war. Yeah. So when we invest in such emerging industries, we tend to buy ETFs that covers the entire industry, so that even if you pick 8 correct and you have 2 wrong, overall you are making good returns on it.
And in that sense of being broad-based, right? And going out there and picking ETFs rather than companies itself, how do you then select your ETFs then? Because just to put it very bluntly, right? Like every fund house, every ETF house is creating like very similar ETFs, right? Other than the very niche themes out there, many people are very similar. So how do you like kind of know who to choose?
Just to give you an idea of how many ETFs there are today, traded and listed across all the global exchanges, there's more than 10,000 ETFs.
Wow, crazy.
And they are growing day by day. So it is quite impossible for a human to look through that 10,000 over an increasing number of ETFs. So we use advanced software to analyze them, using computer systems, and we look at many different factors, including how much of diversification effect they have. So that's one. We also look at the reputation of the ETF provider. Is this, one of the top 5 ETF providers, or is this, a ETF provider which maybe not everyone had heard about? We also look at the ETF fund size as a representation of their stability.
So what is the OK fund size?
More than $1 billion.
Okay, so it's a liquidity kind of thing.
Yes, so the other thing we look at is also the daily liquidity, because we want to make sure that in unforeseen circumstances where markets are shaky and for some reason you need to cash out, you can get out at a good price because it's liquid. And we also look at the bid-ask spread to make sure that you can get out at a reasonable bid-ask spread, as well as expense ratio.
Okay, help me understand what is a beta spread.
So so every day when you look at the exchange, right,
learning new things every day. Yes,
there's a pair of prices. You have the guys who wants to buy it, so that will be the bid price, and then you have the guys who want to sell it. That's the ask price. Yeah. So typically, the bid ask spread for a very liquid stock will be one tick. Okay, so
0.01 is it?
Yes, 0.01 for anything that's traded, more than $1, it should be about 0.01. Yeah. So you want to make sure that the bid and the ask is only separated by 0.01 and not 0.03, because there are some stocks, where the liquidity is very thin, then you would see very wide bid-ask spread. So you got to force yourself, if you want to sell it, right away, and you need the cash right away, right? You can't afford to wait. Then you have to sell it at a bid price, and you lose 3 ticks, 0.03 in the process. Yeah, so that's not good.
So that's bid-ask spread, right? For you guys out there listening, that's cool stuff. And then, okay, I've since we're talking so much about ETFs, right? I have this one very interesting question that, to date, right, I cannot really kind of factor this thing, because in an ETF, it's a basket of companies or a basket of, whatever it is, right? It's a compounded product in that sense, right? But then how is that ETF priced? Are we looking at a market mechanism, where the market then decides, okay, this ETF is worth this price? Or is there some sort of, correlation with the underlying asset basket?
Yes, naturally, it needs to be anchored to the NAV. NAV stands for net asset value of the ETF itself. So take, for example, if this ETF, holds Facebook, it holds some other tech stocks, then the value of the ETF would be what is the total market value of the holdings that it holds in Facebook and other tech stocks. Yeah. So that must be the anchor value. And while there may be a little bit of deviation from the NAV, by and large, when the deviation gets too huge, people will arbitrage on it. Yeah. So for example, if the value of the NAV value is, $100, but the exchange is trading at $99, then I will arbitrage and buy it off the exchange. Something that's worth $100 for $99. Yeah, so I make a $1 gain.
Okay.
Yeah.
So the market is so efficient that you don't really see that kind of price difference.
Yes.
Okay, that's interesting. That's good stuff. So then, in that grand scheme of being broadly diversified and pursuing the whole ETF macro strategy, right? What is your take on like things like crypto, things like the whole like disruptive space?
Yeah, so I study a lot of economics, especially monetary economics.
Yeah.
So I know a lot of people like to speculate in cryptocurrencies, Bitcoin, Litecoin, and I don't know, so many different
Semicoin.
names that comes out. Yeah, any names that you can think
We can
of.
start a coin tomorrow, so if we want. Yeah.
Yes. So the long story short, for any form of money, it has to satisfy a few characteristics. First of all, the value of the money must be relatively stable. Just imagine, this Bitcoin where the value keeps changing day from day. Today, if you use one Bitcoin, maybe you can buy 10 apples. Tomorrow, you might buy 15 apples. And the following day, you might only buy 5 apples using the same Bitcoin. Is this the kind of money that we want? That's not going to be very feasible, right, in our context.
It'd be too exciting buying a cup of kopi. It's like, wow, auntie, wow, very expensive.
Yeah, you thought you could have bought that coffee, right? And then the next moment, while the auntie is making that coffee,
making the change with you.
Oh, too bad, Bitcoin have already moved. I can't serve you that coffee, man. I can only serve you half the cup.
Yeah.
So that's not good as a form of money, and as a store value, it is also not good. Because it keeps fluctuating, right? You don't want your wealth to fluctuate like that, because there's no science behind it. Today it could be worth $100. Tomorrow it could be worth $50. And if you're on the wrong timing, it can be very disastrous. Yeah. Then
because that is the other side of the discussion, right? Where some people are saying, oh, maybe crypto is not a form of money. It is a form of asset. It's like a gold, right? Like Bitcoin is like digital gold, right? So your take is that it's too volatile to be gold in that sense.
Yes. And of course, the other thing about investment asset class, right? Those that can be fundamentally valued are the ones with some form of cash flows. For example, if you look at stocks, these listed companies, they make profits and they distribute these profits as dividends. So because of these cash flows, you can reasonably value the stocks. Take, for example, if AutoWealth were to be listed, and each year...
Is that like a signal? Are you dropping a signal? Oh, we get there someday? Okay.
Yeah. So take, for example, if AutoWealth distributes $1 dividend per year, reasonably speaking, you wouldn't want to buy AutoWealth shares when it's trading at $100 because it would take you 100 years to get back the investment that you have made by investing $100 onto the share price, right? But if I were to say that the AutoWealth share price is about $20, you will feel that it is somewhat reasonable because within 20 years, you recover back your investment. And anything beyond 20 years, each year you will be making pure profits on it. Yeah, so there's some form of logic behind how a share price can be fundamentally derived. The same goes for bonds. There's a bond coupon, or in simple English, interest that you receive by holding that bond. So because of these cash flows, you know how much you're willing to pay for the bond. Yeah, because if the interest is too low, you will say, it's not interesting to me at all. I don't want to invest. Then naturally, there's not enough buyers. People, the bond price will go down because of demand and supply, and the yield will start increasing until a value where it's reasonably appealing. Then people start buying it again. So bonds and stocks, they tend to have fundamental value because of these cash flows. If you look at things like commodities, gold, it doesn't give you anything other than, the glittering yellow. When you look at it, you feel psychologically shook about it. But else not, it doesn't give you any monetary value at all. And we can argue until the cow come home whether gold should be valued at $1,000 US, $2,000 US, or $10,000 US. Everybody can, make a 3-page long pitch about it, what kind of price it should be. And the same way goes for Bitcoin, right? Yeah, because these are all pure speculation. I mean, I would rather go to a casino and derive, some excitement. Yeah.
Okay, fair. So essentially, you are classifying assets where they are all like cash flow generation. So there's some sort of cash flow calculation that you can, underpin to it, like bond stocks, like property, those kind of stuff.
Yes, it
You
needs
know.
to be scientific.
Yeah, okay. So there must be some sort of underlying scientific cash flow calculation in that sense. And then there are all these other things like gold, like Bitcoin, like art pieces, that like NFTs, right? Like
Tulips used
the,
to buy condos.
the Dutch tulip crisis, right? And okay, so those things are to you, you will not touch them at all.
Yes, that's our philosophy.
Okay. So then when we talk about like, cash flow and bonds and all those kind of stuff, right? I think there's a recent topic about like bond yields rising, or there's this general fear. Okay, so people kind of tie it up, right? Like inflation, bond yield, and stock market movement. It's like as though it's a very clean thing. But I want to hear like from your perspective, what is going on, with all these kind of movements in the market.
Yeah. For the layman out there, when we say rising yields, it sounds positive, right? Rising yield
It sounds very
sounds
positive.
very
Like make more
positive.
money, right?
Yes. But in actual fact, right, how did it happen? It happens when people sell bonds. When the prices of bonds goes down, the yield goes up. Yeah. So the reason why people are concerned is because of these overselling of bonds, pushing the bond price down. And this happens because the markets are seeing that our economic recovery is on solid footing. And this is, by and large, truly factual. If you, for example, look at the unemployment situation, if you look at the increase in wages, if you look at the overall economic growth, corporate earnings growth, we all know that the economic recovery is getting on very solid footing. One statistics that a lot of people don't know is that if we look at fourth quarter 2020 corporate earnings of the S&P 500 largest companies, they are almost 4% higher than the year before, which means fourth quarter of 2019. What this means is that corporate earnings have went way above what it used to be pre-COVID.
Market cap weighted? Is this market cap weighted?
No, we are just looking.
Just like all the companies add
Yes.
together. Okay.
Yes.
Okay.
It's not market cap weighted.
Okay.
Yeah. So what this tells us is that by and large, the overall industries and economy has already grown way above what we used to be pre-COVID. So we are growing quite well today. Yeah. And that that truly reflects why bond prices starts coming off, because people are going risk on.
Okay.
Yeah, because on solid economic footing, you want to take risk.
Okay.
But however,
Yeah, that's the thing, right? Like, why is the market coming down?
yes. So now people are concerned about bonds being sold and the yields driving up, and concerned about inflation. So I've addressed inflation earlier on. While we see that inflation will eventually come on stream, but it's going to be slow and steady. It's not going to be a situation of runaway inflation. So I think the fears are overblown. Yeah.
Why the confidence though? Why there's no risk of runaway inflation?
Because the central bankers, they have the best statistics and they have the best people to analyze the economic indicators. So they know when to tighten and when to loosen it. Yeah. So I trust that they will do what is good, and markets will not go into a tailspin. We will not see runaway inflation.
So you believe that we have already learned from our past lessons?
That's right.
Okay, so things will not repeat itself in that sense.
That's right.
Okay,
Yeah.
okay.
And for all this hoo-ha about rising bond yields, right? When we look at our portfolios, which also have government bonds, after you see so much of gloomy headlines, the actual impact is only a minus 3% on our government bonds. It is insignificant at all. Yeah. So I really don't see a reason why people need to be overly concerned about it.
So then how does that translate to the market shock then? Like, the S&P for like 2 weeks was like going a little bit, volatility went up a little bit, and like prices were moving, and the headlines were tying to like increased bond yield and risk of inflation. So why did the market shake like that then?
The true reason is that, statistically, each year we will see about 3 to 4 market corrections. This is normal. It's just like our weather, right? When you have very good weather for a persistent period of time, you are just waiting for the next storm to come. Yeah, and it is only natural. Our nature works like that. When you have good days, you will have some rainy days. So it's a natural cycle. For the stock markets, it's about 3 to 4 times corrections in a year. The last time we have a market correction, that was the middle of October last year. So if you count the calendar months, we are actually due for the next correction, which is why that correction took place in late February.
Okay, so indirectly, what you're trying to tell me is don't need to string everything together. They operate independently.
Yes, and often when you have a market correction, then your news agencies and analysts start searching conveniently for a reason why it
my
happens.
God, so irritating.
Yeah.
yeah. It happens so often, and it's just trying to get eyeballs, right? In that sense.
Yes.
How does that then affect your investment strategies then? Do you actively adjust your portfolio with this kind of like yield changes or like market corrections? How should people look at it? Because I think a lot of people, when they tune in, they're trying to learn from the pros, right? So that I want to hear from you guys. Given that bond yields are changing, given that market corrects from every quarter to quarter on or average 3 to 4 times a year, how do you guys look at that and adjust your portfolio, or do you even do that?
Yeah, so we don't actively and discretionarily adjust the allocations. But however, portfolio rebalancing is part of our investment strategy. So portfolio rebalancing means that when an asset class goes up too much, we will cut a little bit, and shift those funds into the asset classes that didn't do so well. So it's a reversion of mean theory. So take, for example, you have the US-China trade war at the last quarter of 2018. Okay, during that period, stocks went into a tailspin. No matter which region you invested in, it declined about close to, 20-30%. But whereas government bonds, being backed by the government, they kind of held their value quite well. So as a proportion of the portfolio, the bonds became slightly larger than what was the original target weights. If you start off with a 60 stocks, 40 bonds portfolio, it could have become a 55-45 portfolio. So all we need to do is to cut that extra weight in bonds and then shift those money to buy stocks while they are now precisely cheap.
Okay.
So when the recovery eventually takes place, you have more stocks to enjoy this recovery, and then you reverse again. So this is being done to make sure that the risk profile is kept consistent. If the user wants a 60-40 portfolio, we try to maintain it 60-40, because this is the risk profile of the user. But of course, by us selling high and buying low from time to time, we are locking in extra returns. So the same case for the COVID pandemic. We have done the same. And because the COVID pandemic was more volatile, through this portfolio rebalancing, we managed to make about 4% extra returns.
Compared to the usual expected 8 to 9.
Yes.
Okay, that's pretty cool. That's a 50% higher than expected returns.
Exactly.
Right, that's cool. And so last questions, right? After you shared all these different things, right? And all from the macro to the ETF to, reverse to mean and all these kind of ideas, under what scenario will you adjust your composition?
Our portfolio strategies are designed to last over many market cycles, over decades. So from a design perspective, right at the start, it is intended to withstand any change in market environment. So it works most of the time. There will only be limited windows where it doesn't work that well. But by and large, over a long period of time, you average it out, you will make decent profits. Yeah. So I don't think there will be ever a need for us to adjust our investment strategy as long as stocks and bonds remain the two largest asset class in the world. It has been the case for the last century. I believe it will be the same for the next century.
Cool. Thank you. Thanks for sharing. Appreciate your time.
Thank you.
Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the Financial Coconut. Knowledge is that much more powerful and interesting when shared, debated, and discussed. Join our community Telegram group, follow us on our social, sign up for our weekly newsletter. Everything is in the description below. And if you love us, want to help us grow, definitely share the podcast with your friends and on your socials. Also, if you have some interesting thoughts to share or know someone that you want to hear more from, reach out to us through hello@thefinancialcoconut.com. With that, have a great day ahead. Stay tuned next week and always remember, personal finance can be chill, clear, and sustainable for all. Okay, I got some questions for you, some things that we ask every single guest. Okay, so the very first question is, what is a core life principle that you hold closely to?
One of those philosophies or principles that I hold closely is this Chinese saying. In Chinese language, it's called 尽人事,听天命. So in everything we do, we want to make sure we do the best we can. But once you have done that, sometimes in reality, things don't work out the way you want it to be, right? So we need to live happily, right? Let's not agonize over how the reality will be. As long as you have tried your best, be mentally prepared that things do not turn out that well and just move on.
Nice, thanks. Next question. What is a personal finance advice that you feel needs to be further propagated?
It's really to focus on the big picture, means winning the war, and focus less on nitty-gritty, which is like the small little battlefields out there. All we need to do is to know which are the techniques that can more or less guarantee us that big success, and forget about, those stock picking, market timing, unless you are Warren Buffett or George Soros.
Cool, George Soros. And number 3, last question, is which part of your life are you giving extra focus on now?
I think right now we are focusing a lot about giving back to the society. So take, for example, AutoWealth. 3 years or I think 2 years ago, we started a bursary called the AutoWealth Bursary Fund.
So cute.
Yeah. So every year we support a financially needy student at the NUS Business School, where both me and my co-founder Noel Lee came from. So we will support a needy student with 6,000 Singapore dollars each academic year.
Nice. I should go back to school. I dropped off at NUS. But okay, anyway, good stuff. Thanks for coming. Thanks for sharing. Awesome.
This podcast is supported by Invesco. Why invest in ETFs? Because there's a solution for whatever your portfolio needs. Whether you're exploring ways to manage volatility, seeking income and diversification opportunities, or looking for tax management strategies, Invesco has over 200 ETFs to help you meet your financial goals. Discover the possibilities at Invesco.com/ETF solutions. Before investing, consider the fund's investment objectives, risk, charges, and expenses. Visit Invesco.com for a prospectus with this information. Read it carefully before investing. Risks involved with investing in ETFs, including possible loss of money. ETFs are subject to risks similar to those of stocks. Invesco Distributors, Inc.